This video is brought to you by Public. Get one totally free stock by going to metkevin.com/public worth all the way up to $70. They don't buy or sell your information. You can follow me on their social platform at MeetKevin. Go to metkevin.com/public. And if any of what you're about to hear in this video makes you nervous, make sure to get life insurance in as little as 5 minutes by going to metkevin.com/life. Maybe not September. Hey everyone, me Kevin here. Yesterday we talked about a JPOW tapering at some point, and all eyes went straight to September 22nd, which is the next FOMC meeting, which will follow a likely strong jobs report on the 3rd of September, and then inflation on the 14th of September. That is inflationary CPI readings coming out on the 14th of September. Both of those reports coming out right before the September 22nd FOMC meeting, the end to the meeting, where Jerome Powell will come out and release his statement as to whether or not he will start the taper. So right now, a lot of people are marking September 22nd on their calendar. That's it. Taper's coming. But wait a minute. What if the taper doesn't come September 22nd, and why might it not? Well, the Wall Street Journal today talked about exactly that. They mentioned that they actually don't expect the Federal Reserve to taper until November at the earliest. Their logic behind this is that the Fed will likely want to figure out what's going to happen in Congress with the debt limit political standoff. Remember, every year Congress is supposed to get a budget done by September 30th. Now, oftentimes they end up doing these stopgap measures and they have these political debt ceiling fights, but there is always this uncertainty that happens around these negotiations that, oh my gosh, what if we run out of money? Then the Treasury is no longer able to pay its bills, and then we have big O problems. Like, we have a big shutdown. We've seen big shutdown debacles before. The United States bonds lose trust. The dollar loses value. Everything ends up turning into a disaster. Now, what's interesting is the timing here. See, the Treasury, on the Treasury's website, literally says, we will run out of money sometime in October or November without a debt ceiling increase. They literally say that on their website. Like, I wonder if you called up your spouse one day, you're like, yeah, hey, we're going to run out of money in October or November unless we get our credit limit bumped up. Like, that doesn't sound very stable when you think about it that way. But that's how our government operates. And these negotiations can definitely lead to fluctuations in bond prices. Now, we don't actually expect to not raise the debt limit. We always end up raising the debt limit. Mitch McConnell ends up trying to sandbag the negotiations to say, I won't raise the debt limit if you're going to spend all this money on infrastructure, which is exactly what we expect him to do. So we do expect this to be a tenuous and uncertain time. So there could be potential for a market catalyst towards the downside between the end of September and the middle of October. I expect this to be somewhat short-term, though, because they generally always raise the debt limit, which, that has its own implications. But the point of this is, all of this debt ceiling discussion, is that the very next FOMC meeting after September 22nd isn't actually until November 3rd. So it's entirely possible that we could spend all of September and October without a taper. That is, the taper won't actually have started yet. We could potentially see yields on treasuries remain low. We do expect that once the taper begins, that treasury yields will bump. In fact, I saw this very interesting chart. Take a look at this right here. No tapering, expected tapering, surprise tapering. And these are sort of the expectations for what 10-year treasury rates might do. And I think it's very interesting that right here, this white line is what we saw in terms of 10-year treasury yields skyrocketing at the beginning of the year. And in order for Michael Burry to be right, according to this projection of what 10-year treasuries do, so if you're following Michael Burry short by shorting the 10-year bond ETF, you would really want to see a surprise tapering, because a surprise tapering might push the 10-year treasury yields back to about 1.5%. An expected taper is really only expected, per Bloomberg here, to keep 10-year treasury yields around 1.2, which I thought was interesting that once the taper happens, Bloomberg actually isn't really expecting the 10-year Treasury yield to skyrocket. And if they just delay their taper, the 10-year Treasury might just continue to slip until the Fed actually does taper. Now, keep in mind right here, this sort of inflection point they list here probably looks like it's somewhere around November. And then this here is about January. So if we go with the expected taper direction, then we'll still have Treasury yields rotate down even with the taper, which is not so good for Michael Burry. So in my opinion, this is actually quite fascinating because we've got the market suggesting whether we have a taper or not, we really don't expect 10-year Treasury yields to skyrocket. Like the market's kind of pricing in the taper. We expect the taper to come September 22nd, but there's room for the Fed to delay it because of debt ceiling negotiations, which debt ceiling negotiations could lead to a little bit of fluctuations in the market. But because of Jerome Powell kind of being like, I'm not so terribly worried about inflation, maybe there's room for waiting, which the White House, the Office of Management and Budget, just released their mid-session report. And they actually revised their original inflationary forecast from 2% for the fourth quarter of 2021, so the last part of this year. Their forecast was 2% inflation. They bumped that to 4.8% inflation. And when I pull up their document here, take a look at some of the things they mention here, and it's really important for interest rates. Look at this. In the document, they see here, lastly, faster than expected rates of economic growth and temporary inflation pressures have caused financial markets and professional forecasters alike to rise upwards their estimates for interest rates in 2023 and beyond. And this is where they make the revision to 4.8%. But this was interesting here. The mid-session report projections take into account that this shift on interest rates won't happen in 2024, which is what we originally expected. Instead, it'll happen sometime in the beginning of 2023. So basically, here you have the federal government saying, hey, we're going to start expecting to spend more money on interest at the beginning of 2023 because we do think that interest rates will go up. Now, that was pretty neat because when you start having the federal government budget in that they're going to pay more in interest, that might, in my opinion, I don't know how much talking they do with the Fed, but it's certainly more than I get to talk to the Fed. To me, that's a little bit of a sign that, okay, so 2023, beginning of 2023, that's really what we're looking at, huh? Now, in the meantime, and these are some of the things that Jerome Powell's looking at, we obviously see some inflections to the downside in inflation already, such as spending on cars and durable goods like refrigerators. Those are falling. We also saw that household income did go up about 1.1% in July, but consumer spending only went up 0.3%. And sometimes you see consumer spending go down when people fear inflation. So in other words, when there's more fear of inflation, people tend to save more money. In fact, take a look at this chart right here. Now this chart, the spikes here have to do with on the left, the $1,200 stimulus check, then $600, then $1,400. But a lot of folks pay attention to this particular chart here to suggest that, hey, if people fear inflation more, they will save more money. So obviously we're in this phase of a lot of inflation uncertainty. And so how do we pull all of this madness and information together? Well, the best thing to do is just write these catalysts down. Remember, we've got jobs report on September 3rd. We've got CPI data on September 14th. We've got the FOMC meeting on the 22nd, which is where we think there could be a taper. But the Wall Street Journal is now expecting this to potentially get delayed to November 3rd, which means we might have a little bit of uncertainty in the marketplace between the end of September and mid-October, thanks to the budget discussion and the debt ceiling discussion. And then maybe we get that taper in November, because after all, Jerome Powell is not as worried about inflation as a lot of consumers are, who are pulling back and spending a little bit less. Now, spending a little bit less could obviously also be due to Delta, but right now we see that almost no forecasters or the Fed really think that Delta is going to be a massive impact to the economy like it previously was. So, fascinating insights. It definitely revised my expectations a little bit. Wanted to share those with you. If you like this sort of information and insight, make sure to subscribe to the channel. Check out the programs on Building Your Wealth link down below. And folks, we'll see you in the next one.